So this is the Chinese contract adjusted from Chinese yuan to dollars and adjusted to ounces from kilograms. That AG, this formula you see up here. So I'm talking up top here. AG1 with the interrogation mark is the front end contract on the futures market. That is the USD to the Chinese yuan adjustment, because obviously in Shanghai it's in yuan. And so there's a currency rate in that. And then that 32.150747 is me being a little bit OCD to the umpteenth degree on the conversion of kilograms to ounces. So metric system to the accepted. So this brings this chart over here to being the leading chart, I think, for silver prices. I'm on the 1 hour mainly because I'm just trying to show you the events of recent, because many people that are regular watchers and viewers, they know already that you and this channel have been suggesting everybody should be bullish, the silver market, and they're all wondering what do we make maybe of the recent events with the price. The one on the left here is your US stroke Western world pricing. Let's go with a different color, and it's just your standard silver market. And you can see technically you this dipped a tiny bit lower. Let's just see, we had a dip down over here. You can see they're trading at different prices, first of all, and there's a premium in the East. So you've got a roughly around 76 at the moment in Shanghai on the formulaic adjustment. Now, I'd imagine markets being relatively efficient, that $4.30 is probably what you would lose if you took delivery in the West at one of the standard areas and shipped in volume. You'd probably have a very marginal profit or a marginal loss. The markets are kind of quite efficient like that. So the West still gets to trade cheaper for now because there's a frictional cost to have it made available, Western delivered silver made available to say that East, someone in China. So they'll keep buying locally where it's just a case of you get it delivered at 76, because to buy at 71, 78, as we are here, by the time you've done everything else, you'd need to have a large amount of scale, and you'd probably barely be worth it, and a lot of extra hassle. So that's the premium difference for arbitraging the different markets. These are frictional. But what you'll notice is that if I just tidy up, we traded lower over here, and we took out that low on the Chinese market. But by the time the Western market opened and it was trading down, the Chinese market started to trade back up towards that. So we got a floor in a little bit earlier, and we've been maintaining that premium. Also bearing in mind they have different trading hours. So sometimes one is not available and then the other one drifts on its own. But I'd start to suggest that this formula might be closer to your true market. Would have just reduced some of the retail further. We had current initial margin at 25. That's on the COMEX 5,000 silver futures contract. Current maintenance, and then the new initial maintenance is now 32.5. And it wasn't that long ago, it was barely a week, that you were moving from 20 to 25. So you've effectively in quite short duration. This is at their discretion, and of course they'll want to tame the market. Many people see them as co-conspirators with the banking cartel in terms of the suppression of silver markets. So they don't want any speculators getting hot and rich on a bank that's heftily short. There's been quite a few rumors that there were banks unable to deliver. A bank, many banks, one bank, who knows, or maybe just a rumor that doesn't have any validation behind it. So they took some of the sting out on the thin markets with these margin. But nothing on the big picture in terms of what we expect. We expect a 90.5 run as a interim target. We expect 333 as a full target, but not the final high. And we expect 4-digit silver in a dollar debasement, a chronic era, where the gold-silver ratio will be heading towards single digits between each other. So in terms of everything we've spoken of before, Jesse, no changes there. It's a very good point you make. I mean, I've retweeted about the China export thing, but there's a qualification in that I didn't put in the tweet myself, and that is there's 44 companies already licensed to allow export of silver who are recognized merchants for some or other commercial reason that can export regardless. What is probable, though, is China has reduced the possibility that random people can show up and start sending metals over the board. And they said there's only 44 companies that can export. We want them registered. We want to know who they are. And at any given moment, they could say nothing for this week or nothing for next week for whatever reason. And those people who would want to retain their license would absolutely comply, or they'd find themselves shut down. So it's more about grabbing the reins and the ropes, and what's in our country is staying in our country. What really needs to go out for a valid reason can go out, but we get to know every single ounce and who's doing it, and they have to report to us the amounts, and we'll be controlling that. So it's more a step in that direction than complete export ban in the absolute sense. So it's good that you make that qualification, and I just put an extra tap of the hammer on top of that nail so that everybody's clear. But there's no doubting about the trajectory. Governments want the information, the data, and the control over how precious metals, critical minerals, and metals are moving in terms of in and out of their land, and they're not going to have themselves depleted of key strategic resources by rogue commercial elements or even retail that are trying to arbitrage a market for personal gain or do anything else. So the reins are certainly taken up and the control is brought. So that's point number one. You also mentioned our friend Elon Musk, who's actually a big silver consumer, reflecting his concern. And that kind of went with the rampant climb in the margins. So we could see that suddenly we were going mainstream. By the time Elon's tweeting about it, a lot of normies that just follow Elon because he's always put in front of you on the algo. So silver's doing everything we believe it should be doing, and doing so very getting more volatile, it has to be said. And I think some of that has got to do with the fact that we've had a little bit of light trading markets in the lead up to Christmas, post-Christmas, and the lead up now of New Year. So we're recording this on the 31st of December. Happy New Year to everybody by the time they watch this. And my overall take is that we're getting a little spike in volatility. I do want to highlight that silver margins for speculation have jumped twice. It may be worth, I can talk through this. I don't suppose I have to screen share for that, but we're on the 5,000 ounce contracts, the COMEX 5,000 ounce contracts. You are at 20K. They then upped it to 25, and they've now upped the 25 to 32.5. So that's a case of two back-to-back increases that have essentially taken you from 20,000 to 32,500 in total. That additional 12,500 is about 62.5% that you've had in quite short succession in two separate moves. So that will have caused a bit of chop. I would argue there's a couple of interesting things going on, and it becomes a question of which is the real market. And my opinion is that the Shanghai is now the real market for silver. It may be worth sharing the differences. There is a premium between the COMEX and the Western world's pricing, all aspects of Western world pricing versus Shanghai. And I would say also that an immense amount of delivery seems to be taking place. That's the other thing that's happened that's driven this, in that there is real. So here's the difference in a sense between gold's performance and silver's performance for me. Gold is the banner for the debasement of debt and fiat. And you've got out of that a catch-up year of 70% because we've been debasing slowly for a lengthy period, and we've actually had gold and silver suppression where it wasn't allowed to catch up, it should have been linear. Every year you lose, you were experiencing 3-5% inflation. You should have had a 5% move in gold and silver. But for decades, it hasn't been like that. So here's the great gift that you're getting. You're getting catch-up moves for suppression error. The difference between gold and silver in terms of their performances is that in the silver markets, it was the ultimate suppression tool, and you had above ground availability that has now largely been far more depleted. So in the silver part of the gold market, not only are you getting the inflation debasement trade elements that has driven gold, so you start with the 70% gold has, you've also had, as a loss of trust in the Western system, you've had people saying it now matters more to physically hold and control the actual metal. So they have been increased delivery, mark for delivery component in the futures market has actually seen a massive run in you don't own it unless you hold it physically. So we've had lots of images on X of even just retail Chinese people with the very popular 16 kilogram slabs, which are 500 ounce bars. The largest standard is 1,000 ounce bar. I think I stand corrected that when they say 5,000 ounce, I think it's 5 of the 1,000 ounces is the contract. But I might be incorrect. Someone will correct me below. I'll have to double check that. But anyway, you're having a two-tier pricing system as well. So the West currently represents, in essence, a discount window for the East. And if you want to follow what direction COMEX silver or your broker in who you're trading with in the silver markets in the Western realm, what's likely to be happening, whether you're going to be going up or down, it's almost more beneficial to be watching the Shanghai price because you get the Asian session and you see what happens there. And the Western market is now following the Eastern market because the delivery market, the most aggressive delivery market, is now in the East. And that's the difference. That's the premium on top of gold. So silver starts with the 70% monetary metal debasement gains that gold has had as almost a natural, that's what they're all getting as monetary metals. And then on top of that, it's getting the actual shortage, the run on the physical shortage. Gold, less of a shortage aspect because a lot of bullion stored. Central banks hold a lot of it. They can lease it out, lend it, do whatever. But in terms of consumption, silver has consumption. So I think that's the difference between the two, which is the main driver behind your question. How long does silver outperform gold? I also dropped other things in there, like watch the Shanghai price, but I'll hand back to you on that. I think any place that is doing actual delivery on the highest level, as always with technical analysis, they will always say volume is an endorsement. It's like a number of voters for a certain price. If you have a very thinly traded item, I could list a family held company where me and my family members hold 95% of the equity, and we have an IPO with a very minor amount, and we let the market push it around. And at any point, we can whale in and buy up our own remaining 5%, or we can dump it. That changes the entire market cap valuation, including for the 95%. So we'll always say to you, volume, true volume is an endorsement for the price. Thin volume is not necessarily as strong an endorsement on the price. So in the case of silver, I'll say whoever's where the bulk of the delivery is taking place. That said, it would not be accurate to just say that COMEX and LBM are just paper markets, because what's actually happening is delivery is being called for there too. But you do still have this premium. It's worth possibly showing that.
Francis Hunt's analysis points to a structural regime change in the silver market rather than a speculative spike. The most important takeaway is that price discovery is migrating east, with Shanghai increasingly acting as the lead market due to physical delivery, sustained premiums, and consistent demand. When a market that demands delivery leads price, paper-based suppression mechanisms lose effectiveness. The persistent premium in Shanghai indicates that physical silver is already tighter than Western futures pricing suggests. COMEX margin hikes, up over 60% in weeks, appear less about volatility management and more about forcing leverage out of a market where banks are structurally short. This reduces paper participation but does not resolve physical scarcity. China's tightening grip on silver exports further reinforces the bullish case. While not an outright ban, restricting exports to licensed entities gives authorities granular control over strategic metal flows, limiting arbitrage and ensuring domestic availability. This shifts silver from a purely tradable commodity toward a strategic resource. For investors, this implies that Western prices may increasingly lag reality, acting as a temporary discount window. Silver's dual role as a monetary metal benefiting from fiat debasement and as an industrial metal facing genuine supply depletion creates asymmetric upside. Volatility will rise, but the trajectory remains decisively higher, with physical ownership and low leverage exposure increasingly favored over paper instruments.